Hi, this is Nathan Hugh with Loan Depot. What's going on in the mortgage market? Despite all the craziness, we're still open, still helping people buy their houses, still helping people lower their payments, even helping people get money out of their homes so they can weather this storm. With the Fed rate near zero, a lot of people have assumed that mortgage rates would also drop to near zero. I wish that was the case. Problem is, the Fed rate does not automatically correlate to mortgage rates. Historically, it has been the 10-year Treasury note that most closely correlates to mortgage rates. And even with the 10-year Treasury at an all-time low, mortgage rates have still not fallen. Quite a few people want to know why. Well, they say the road to hell is paved with good intentions, and when the Fed cut rates close to zero and pumped $200 billion into mortgage-backed securities, that should have lowered mortgage interest rates and increased the amount of money available for mortgage lenders to loan, right? But get this, the Fed had just recently cut its interest rate by 0.5%, which had already created a huge wave of people refinancing their loans. Lenders were overwhelmed with the demand and cracks began to show in the system. What happened? The sudden influx of money and low rates created a tsunami of refinances, which resulted in huge losses for mortgage lenders as people paid off their mortgages early when they refinanced. These losses were supposed to be offset by the lenders issuing new loans, but the realized losses were much greater than future profits. Put it this way, if you just got burnt by losses on the loans you made 2 years ago, would you be in a rush to make new loans? Of course not. What did they do to protect themselves? They raised prices to offset the losses they took on the old loans. With all the people refinancing and paying off their loans early, this drives the value of mortgage-backed securities down. And this is where the money to make mortgage loans comes from. Understand when the value of mortgage-backed securities go down, mortgage rates go up. Exactly what the government was trying to avoid. Get that? Investors were losing money because the government was trying to lower rates. But what the Fed did was actually causing the value of their investments to go down. And it wasn't just a little bit of money. There are a large number of mortgage lenders who have stopped lending altogether because they have lost so much money. Another thing that is happening is the federal government has mandated forbearance of mortgage payments, which further increases the losses of mortgage companies. The truth is, there's only so many lenders making mortgage loans. As the Fed slashed rates and people rushed to refinance, they swamped the system. To slow things down and offset their losses, lenders actually raised their rates contrary to what the Feds thought would happen. Rates will hopefully come down as the losses are offset by income generated by new loans, but expect rates not to fall as low or as far as they have in the past, because while the federal government has lowered the interest rate and increased the money supply, at the same time they have increased the cost of doing business for mortgage lenders. To put everything into perspective, having 30-year mortgage rates in the 3 to 4% range is still a fantastic opportunity for most people. If you would like to learn if you could benefit at this time, give me a call or text me, 805-878-1007. Again, that's 805-878-1007.